Welcome back to the ProTicker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We've got quite a stack of recent financial news sources here today, seeing stuff from Reuters, Bloomberg, MarketWatch, CNBC. Our mission in this deep dive, as always, is to try and, well, slice through the noise, connect some dots for you, and pull out the really key insights. Maybe find some surprising nuggets, too.
Yeah, it feels like one of those weeks where the global economic picture is complex, almost contradictory depending on which headline you grab first. We're definitely seeing the impact of trade policy rippling through forecasts, through the actual data now. And at the same time, you've got these debates heating up inside the Federal Reserve about what to do with interest rates.
Right. And then there are these, well, pretty loud warnings about the U.S. fiscal situation, the debt, and what that could mean for the bond market. That seems to be a recurring theme.
Absolutely. And mixed in with all that, big picture stuff, there are some really interesting company-specific things happening, especially in tech, looking at AI and some of the brain-computer interface news.
Okay, so it's a lot. But hopefully, by focusing on the essentials from these sources, we can build a clearer picture for you.
Let's dive right in. That first big theme that really jumps out is, well, tariffs and trade policy and how they're hitting the global outlook.
Yes, I saw that too. Several sources, like those Reuters and CNBC articles looking at the OECD outlook, and also China's factory activity numbers,
Yeah.
they're really hammering this point home. It feels like this trade picture, which has been sort of simmering, is now actually showing up in the numbers, in a measurable way.
That's exactly it. And what's striking is seeing a big body like the OECD actually cutting its global growth forecasts. And crucially, citing the trade environment as a key reason. According to that CNBC piece, they trimmed the global outlook down to 2.9% from 3.1% for both 2025 and 2026.
Okay, a slight trim globally.
But look at the U.S. forecast for 2025. That's a much steeper cut. They took it down from 2.2% all the way to 1.6%.
Wow. Okay, that is significant for the U.S. And the reason the OECD gave, just the fallout from the trade war, the tariffs, the policy uncertainty, it's all weighing on expectations.
Yeah, and it's interesting, their forecast kind of assumes the mid-May tariff rates just stick, even though there are obviously challenges and debates around them.
So that assumption alone builds in a level of uncertainty.
It really does. It just underscores how much noise that policy landscape is creating. And look, this isn't just forecasts. We're seeing it in the hard data. Those CNBC articles on China's May factory activity, a perfect example. The private Caixin S&P Global Manufacturing PMI.
Right, the one that often reflects the smaller, more export-driven firms.
Exactly. That one shrank to 48.3 in May. That missed estimates. And it's the fastest contraction pace since September 2022. And remember, anything below 50 is contraction.
Okay, and the main driver mentioned in those sources for that specific contraction?
A sharp decline in new export orders. That's where the U.S. tariffs and maybe broader global slowdown fears seem to be hitting hardest.
So it really highlights the external pressure.
Precisely. The Caixin survey is just more sensitive to that external demand. Now, it's worth noting, as CNBC pointed out, China's official PMI was also in contraction, but less severe, at 49.5. Goldman Sachs, quoted in CNBC, suggested maybe it's timing differences, or maybe the Caixin sample, being more export-focused, is just catching that trade impact more clearly.
Okay, so it's really those businesses selling outside China feeling the squeeze the most acutely right now.
Yeah.
Did the Caixin data show anything else?
Yeah, the domestic picture wasn't exactly rosy either. Total new orders contracted for the first time in 8 months. The job market remained grim, shrinking again, and companies apparently saw inventories of finished goods pile up because sales and shipments were down.
Not great signs.
No. Wang Xi, a senior economist at Caixin Insight Group, was quoted saying this increased uncertainty externally is just adding to the headwinds they already face domestically.
And it's not just a U.S.-China thing, is it? The sources mentioned other international reactions.
Right. You had the EU criticizing potential U.S. steel tariff hikes and saying they're ready with countermeasures, and China blaming the U.S. for not upholding some prior trade agreement details. It just adds more layers of complexity.
More policy uncertainty.
Exactly. And one major potential ripple effect the OECD flagged, according to that CNBC article, is inflation. They actually adjusted their inflation forecasts up for countries raising tariffs, especially the U.S.
I saw that. They're projecting U.S. inflation potentially hitting 3.2% for 2025, maybe even nudging towards 4% late that year.
Yeah, though, to be fair, the sources also note there's still a debate about how much tariffs really add to overall inflation, given other economic factors and potential responses from companies.
Sure. Do they pass it all on? Do they absorb some? Does demand fall?
Yeah.
It's complicated.
It is. It's a really crucial debate right now.
Okay, so let's try and connect this complex trade picture to another critical area the sources cover heavily, the Federal Reserve, and what they're thinking about interest rates. That Yahoo Finance article on the Fed rate cut debate was really interesting.
Yes, fascinating. Because what you're seeing is this tariff situation actually creating like an internal divide at the Fed. You've got some officials arguing they should basically look through these tariff impacts, treat them as temporary noise that shouldn't really change their main policy path.
And Fed Governor Chris Waller seems to be a key voice in that look-through camp, according to Yahoo Finance. He apparently thinks any inflation boost from tariffs won't last, and that people's expectations about inflation are still, pretty well anchored.
Right. He even sketched out a scenario for what he called good news rate cuts later this year. Basically, if inflation keeps heading towards 2%, the job market stays solid, and the actual tariff rate ends up around 15%, his latest guess, then maybe cuts are possible.
That's quite a few ifs.
It is. And Chicago Fed President Austin Goolsbee, he had a good line in that same article. He said tariffs are creating dirt in the air, making things messy, but he thinks the path to lower rates is still underneath there, if they can just get past this bumpy patch.
Okay, so that's one side. But there are strong counter-arguments, right?
Oh, definitely. You have people like Minneapolis Fed President Neil Kashkari arguing pretty strongly for holding rates steady for now. He wants more clarity on the path for tariffs and their impact on prices. For him, defending those long-run inflation expectations is paramount.
That makes sense.
Yeah.
And Dallas Fed President Lori Logan. Her comments, also in Yahoo Finance, seemed very cautious.
Extremely. She basically said rates are in a good place right now. It'll take quite some time to know if the risks are really shifting. And she warned pretty directly that cutting rates too much could trigger a spiral of inflation.
Her line about the Fed being well-positioned to wait and be patient really stood out. A direct counter to the calls for immediate cuts.
It is, and you see this reflected in the May Fed Minutes excerpts mentioned in the sources. Some officials were worried about tariffs on intermediate goods and supply chain issues potentially leading to more persistent inflation.
But others saw potential offsets.
Yeah, others pointed to things like ongoing trade negotiations, maybe consumers pushing back on price hikes, a possibly softening economy, or companies choosing to protect market share rather than raise prices aggressively. So a real mix of views even within the Fed itself.
So the same data, the same tariff situation, leading to different interpretations and potentially different policy preferences, that makes their job incredibly tough right now.
Absolutely. It highlights just how complex this is, especially throwing external factors like trade policy into the monetary policy mix.
Okay, let's shift gears again. Another really major theme in these sources, particularly MarketWatch and CNBC, is the U.S. fiscal situation. And Jamie Dimon's warnings were, well, hard to ignore.
Yeah. Damon is really sounding the alarm loud and clear. He's quoted calling the worsening U.S. fiscal picture a big deal, a real problem. That direct quote, "The bond markets are going to have a tough time at some point." That really lands. MarketWatch even mentioned him saying he saw a crack in the bond market recently and worried regulators might panic when things get rough.
Strong words. And the sources link this concern directly to potential legislation, like that House tax bill, the One Big Beautiful Bill Act, as it's nicknamed.
Right. And the estimates cited from groups like the Committee for a Responsible Federal Budget and the Penn-Wharton budget model are huge. They suggest this bill could add trillions to the national debt over 10 years. Penn-Wharton's estimate was around $3.8 trillion.
Trillions, okay. You can see why some lawmakers quoted, like Republican Rep. Thomas Massie calling it a debt bomb ticking, or Senator Rand Paul saying the math doesn't really add up, are raising red flags.
Definitely. These are massive numbers being talked about.
So let's connect this for the listener. Why does this big government number, the national debt, actually matter to your finances? Economists like Tim Quinlan and Mark Zandi, quoted in that CNBC piece, drew a direct line.
Yeah, they explain that a rising government debt burden likely means consumers end up paying a lot more for big things like homes and cars.
How does that work?
Because the interest rates you pay, like for mortgages or auto loans, are fundamentally linked to U.S. Treasury yields, basically. The interest rate the government itself has to pay to borrow money.
Okay. So if the government needs to borrow more and more, investors demand a higher interest rate for that risk, and that higher rate sort of trickles down.
That's the mechanism, especially when the government is issuing vast amounts of new debt, increasing the supply. Investors might demand a higher yield to compensate for the risk. Think about Moody's cutting the U.S. credit rating recently, citing the deficit burden that's a signal of perceived rising risk.
Right. And Mark Zandi in that CNBC article gave that rule of thumb, like a 0.02 percentage point increase in the 10-year yield for each 1 point rise in the debt-to-GDP ratio.
Yeah, and just to illustrate, if that debt-to-GDP ratio were to jump dramatically, say from around 101% now to the nearly 150% Penn Wharton projected under that House bill, well, Zandi's math suggests the 10-year yield could push above 5%, which in turn could mean average 30-year mortgage rates getting close to, say, 7.6%. That's a real hit to affordability for homebuyers.
Ouch. Okay, that makes the connection very clear. And for people already holding bonds.
Rising yields mean falling bond prices, so it hits their investment portfolios too.
There was also that detail about a specific part of the tax bill, Section 899, the revenge tax.
Right.
Bloomberg reported Wall Street worries about that.
Right. Concerns that it could discourage foreign investors from buying U.S. debt, and also that it gives the executive branch maybe too much power in ways that could unsettle markets. Another layer of uncertainty on the demand side for treasuries.
Got it. Now, it wasn't all negative, was it? The sources included some counterpoints.
No, definitely balanced. MarketWatch quoted Treasury Secretary Scott Bessent pushing back on Diamond's gloomiest predictions, saying the goal is to bring the deficit down, albeit slowly. And Peter Azzanaro pointed to recent Treasury auctions seeing pretty solid demand, arguing the term premium, that extra yield for long-term bonds, isn't really showing major cracks yet.
And Derek Tang's perspective, that U.S. exceptionalism might still be mostly intact, but maybe investors should re-examine their own biases and think about diversifying more globally.
Yeah, sort of acknowledging the U.S. market is still the deepest, the most liquid, but warning that continued government action is needed to keep it that way long term. So a complex picture. Big warnings, but also signs of resilience for now.
Okay, so taking all the tariffs, the Fed debate, the debt concerns, how did markets actually react this week based on the CNBC and MarketWatch reports?
Well, it was a bit mixed early on. U.S. stocks managed modest gains Monday, but then futures slipped Tuesday. Yahoo Finance noted renewed trade tensions were partly to blame for that dip.
And elsewhere.
Asia markets were mixed. Australian stocks did okay, partly helped by higher gold and oil prices.
But one positive signal that really jumped out, especially from that MarketWatch piece titled Stocks Will Keep Climbing, was about market breadth.
Ah, yes, breadth. This is important. It's basically about how many stocks are actually participating in the market's move up.
Right, not just a few giants pulling everything along.
Exactly. And Adam Turnquist at LPL Financial, quoted in MarketWatch, sees the improving breadth lately as a bullish sign. He thinks it argues against this just being a bear market rally and suggests something more sustainable.
What are the specific signs of improvement?
Well, the S&P 500's advanced decline line, a key breadth measure, apparently got back to record territory in May. And the percentage of S&P 500 stocks actually in an uptrend jumped significantly from under 30% in April to around 60% more recently.
That's a big shift.
It is, and look at the tech sector, so important due to its weight. In early May, less than 10% of tech stocks were trending up. Now it's reportedly 88%. That's a massive turnaround and seen as very bullish.
Wow. The sources also mentioned something called the Zweig breadth thrust signal firing in late April, an early warning.
Yeah, another technical indicator suggesting underlying strength was building. And Robert Slimer at RBC seemed to agree, noting fresh highs in places like Germany and Canada alongside the U.S. improvement. He thinks stocks could keep climbing for another month or two before maybe needing a pause.
But there's still risks mentioned, right?
Oh, absolutely. They flag things like small cap stocks not participating as much, the potential for those 10-year and 30-year Treasury yields to break higher, which could pressure stocks, and of course, upcoming labor market data. Always a big one.
Okay. Beyond the broad market, any specific moves? Gold.
Yeah, gold dipped a bit Tuesday, according to Bloomberg, maybe on a stronger dollar ahead of that labor data, but it still had a really strong run this year.
Still seen as a hedge.
Goldman Sachs seems to think so. And there was a MarketWatch opinion piece making a very bullish case, linking gold's strength to all the things we've discussed. Dollar uncertainty, rising deficits, policy worries. They even cited technical charts pointing to a, well, very ambitious long-term target of $7,000.
Okay. One to watch. And oil.
Oil prices were rising, according to the daily summaries. Mix of factors. OPEC plus actions keeping supply managed, falling U.S. rig counts, and ongoing supply concerns like the Iran nuclear deal uncertainty and those Canadian wildfires.
Right. All feeding into the supply-demand picture.
Exactly. It all ties back.
Okay. Let's spend a moment on some specific tech developments highlighted in the sources. China's AI industry seems like a big story.
Definitely. MarketWatch and Reuters painted a picture of really booming growth there. Capital spending by the big Chinese cloud players, Baidu, Alibaba, Tencent, the so-called BAT companies, has actually outpaced their U.S. rivals for something like 6 quarters straight.
Despite the U.S. chip restrictions.
Despite the restrictions, Jefferies analysts are quoted being very bullish, forecasting China's AI hardware spending could hit $1 trillion by the end of the decade.
So how are they managing with the restrictions?
The sources mentioned a few strategies. One is stockpiling chips. Apparently, they have enough for data center growth through at least the first half of 2026.
Wow.
Another is getting creative, like using high-end gaming GPUs for some AI tasks. And critically, they're really ramping up their own domestic manufacturing capacity for advanced 7-nanometer chips.
Trying to become self-sufficient. Meanwhile, NVIDIA.
NVIDIA is adapting. Reuters reported they're expected to launch a new, less powerful chip specifically for China in July, one that complies with U.S. export rules.
But there are different views on NVIDIA's future there, right?
Yeah, starkly different. CEO Jensen Huang, quoted in the sources, still sees China as a massive $50 billion market. He called losing it a tremendous loss and even argued the U.S. controls are kind of spurring on local Chinese competitors, giving them spirit, energy, and government support.
Interesting take. But others disagree.
Right. Richard Windsor, quoted in MarketWatch, suggested NVIDIA might actually be better off just giving up on China and focusing elsewhere. He believes China will stay years behind in the core chip technology anyway, so 2 very different strategic paths being debated. And just quickly looping back, TSMC's view, mentioned in Reuters, was basically, yes, U.S. tariffs add some cost, but the underlying demand for AI chips is just incredibly strong, consistently outpacing supply. They are talking to the U.S. Commerce Department about it, though.
Okay. Now switching to another fascinating tech story. Neuralink. Big news there from CNBC.
Huge news. They just closed a massive $650 million funding round.
Wow. That's serious capital for their brain-computer interface work.
It is. And the core tech, as the sources explain, is about translating brain signals directly into commands for external devices.
The telepathy system.
Right.
With the implanted threads and electrodes.
Yeah.
Aimed initially at helping people with severe paralysis.
Exactly. And the really exciting part reported is that they've apparently implanted 5 patients already, and those patients can now control devices just using their thoughts.
That's incredible progress.
It really is. And they have even bigger ambitions, like the BlindSight project aiming to restore vision. That's received an FDA breakthrough device designation. Elon Musk made some pretty bold claims about restoring vision even without eyes or optic nerves.
Okay, bold claims indeed. But the sources also caution it's still a long road to commercialization, and other companies are working on BCIs too.
Absolutely. It's cutting edge, amazing stuff, but still very early days in terms of widespread application. It's not just Neuralink in this space.
Gotcha. And just as a quick aside, one of those CNBC market summaries also happened to mention Tesla's sales in Norway jumped like 213% in May. Kind of an outlier compared to weaker European sales overall.
Yeah, just an interesting little data point tucked in there, perhaps showing some regional pockets of strength.
Okay, one last piece before we wrap up. An unexpected policy move that surfaced in the sources, this one directly hitting individual finances, Social Security and student loans.
Yeah, this was interesting. CNBC reported what they called an abrupt change in policy from the Trump administration. They've paused the practice of cutting Social Security benefits for people who've defaulted on federal student loans.
Right. I remember reading they were planning to resume those cuts, potentially taking up to 15% of benefits from older borrowers in default. So this is a reversal.
It is. The Education Department spokesperson cited a commitment to protecting Social Security recipients, especially those on fixed incomes.
And the context is important here, right? How many people were potentially affected?
The article highlighted there are over 450,000 federal student loan borrowers age 62 and older who are currently in default. Many likely rely heavily on those Social Security benefits.
Yeah, advocates like Carolina Rodriguez quoted in the piece were worried losing those benefits would make it hard for retirees to cover basic needs. So this pause provides some crucial breathing room, at least for now.
Exactly. It's just a really clear example of how a specific policy lever, even one seemingly unrelated to the broader economy, can have a direct and significant financial impact on hundreds of thousands of people's lives.
Wow, okay, we have definitely covered a ton of ground today, pulling threads from all these different sources. We've seen how policy, especially tariffs, seems to be directly hitting global growth forecasts and specific sectors, like those export-focused firms in China.
And how that uncertainty is fueling a real debate inside the Fed about what comes next for interest rates. Different members looking at the same data, drawing different conclusions.
Then we looked at those pretty serious warnings about the U.S. fiscal path, the potential impact on the bond market, and importantly, how that could trickle down to your borrowing costs for things like a house or a car.
Yeah. And amidst all those big macro pressures, we still saw some positive signals, like the improving stock market breadth, suggesting maybe the rally has legs. Plus those fascinating, glimpses into the future with AI developments and the progress in brain-computer interfaces.
It really helps, I think, to bring these seemingly separate headlines together. You start to see the connections, how one thing influences another. It creates a much more cohesive picture of what's going on.
Absolutely. It's all about connecting those dots, trying to understand the underlying currents driving the economy and the markets right now.
So as you digest all this, maybe think about what these interconnected trends could mean for your own financial plans, your investments, or just areas you follow closely.
And maybe a final thought to leave you with, sort of building on everything we've touched on. Given how quickly we're seeing policy decisions on trade, on spending, even on student loan collections ripple through everything from global trade patterns and Fed thinking down to individual finances and market sentiment, well, how much should we really be factoring this kind of political and policy uncertainty into our own financial planning these days?
That's a really good question. Feels more relevant than ever. Thank you for joining us for this deep dive into the source material this morning.
We'll see you all tomorrow morning with new headlines from major financial magazines.